Over the past 9 years, the NASDAQ 100 grew 267% in one of the greatest bull runs in history. During that same period, QYLD lost a third of its value. Now, to be fair, we should include dividends. So here's a comparison of total returns, and still not impressive. The QYLD portfolio includes all the greatest hits from the NASDAQ: Apple, Microsoft, Amazon, Google, etc. It's paying a huge yield, almost 13%, and I'll admit it grabbed my attention. Add to that, it has a long history of paying dividends, including during the 2020 pandemic. QYLD uses a covered call strategy to generate income. Now, personally, I've sold some covered calls on stocks, so I'm familiar with that concept, and it does generate income. It's a bit of work, but it's effective. So there's a lot to like, and I think as a retiree, I fit into the target demographic for QYLD. But when I dug deeper, I found some major issues with this fund. I'm not telling anyone not to invest in QYLD. It's attracted $6 billion, so it must be working for some people. But I think you should be aware of 2 red flags before investing. A quick disclaimer, I'm not a financial advisor. I'm just sharing my personal experiences. Always do your own research before investing. I think a lot of people assume that the benchmark for the NASDAQ 100 Covered Call ETF, also known as QYLD, is the NASDAQ 100, because it's right there in the name. I think specifically people assume that QYLD will be able to capture at least a decent portion, if not all, of those huge returns that the NASDAQ is famous for. QYLD was born on December 11th, 2013, and over the 9 years since then, the NASDAQ 100 has achieved a total return of 297%. That's impressive, and it's outperformed the S&P 500, for example, significantly. So that explains why we'd be interested in a fund that's based on the NASDAQ, right? Well, that's not the case. The link between QYLD and the NASDAQ is weak, as we'll get to. But this is why it's really important to read the objective of a fund. So let's do that right now. QYLD seeks to provide investment results that correspond generally to the price and yield performance, before fees and expenses, of the CBOE NASDAQ 100 Buy Right V2 Index. Are you as excited as I am to match the performance of the CBOE NASDAQ 100 Buy Right V2 Index? I've never heard of this index, so let's see what it's all about. Some Googling revealed that the ticker symbol for this index is BXNT. So I entered that into Yahoo Finance and clicked on a chart for 1 year, and the result was nothing, which is a bit odd. It's difficult to find a chart for this index, but the index was created by the Chicago Board Options Exchange, so that is where I eventually found a chart. Their chart is pretty basic. It doesn't allow for custom periods, but I found a value 2 days before QYLD was launched in December 11, 2013, so that's near enough. Over that period, it went from 415 to 791. That's a total return of less than 100% in just over 9 years. We don't need to do the math to get the exact percentage because QYLD's homepage shows the cumulative return of the BXNT index is 77.41%. So compared to the NASDAQ 100, this BXNT index has performed terribly. 297% versus 77%, it's not even close. But it actually gets worse. QYLD returned less than its benchmark index, just 64.08%. And if you think that sounds low, it is, because that's an annualized return of 5.62% over 9 years. Remember, these numbers are total returns, so that assumes that the dividends are reinvested. Let's return to QYLD's objective for a second. It includes the phrase, before fees and expenses. And I think this might explain, at least to some extent, why QYLD underperforms its benchmark index, BXNT. QYLD's expenses are 0.6%. For a point of comparison, JEPQ is an actively managed fund, and it charges 0.35%. I think 0.6% is high for a fund that's not really actively managed. Unlike JEPQ, the QYLD fund managers don't select stocks. They just sell covered calls every month based on a formula that repeats that we'll get to shortly. So we've established that QYLD tries to keep up with its benchmark, BXNT, which underperforms the NASDAQ and the S&P 500 substantially. Now, in case you're wondering, what is this benchmark BXNT anyway? I'll link a full explanation in the description because it gets a bit lengthy and there's a lot of mathematical formulas in there. But here's the short version. It's an index based on selling covered call options at the money once a month on the NASDAQ 100 index. So it's an index based on another index. And if you don't find that sentence easy to digest, don't worry, we're going to come back to it in a sec. I want to move on to the next problem with QYLD. So I'll summarize the first red flag by saying that it's chasing a benchmark that performs poorly. After looking at this benchmark, the bar for QYLD is so low you could just step over it. Red flag number 2 is contained within the option strategy. Explaining covered calls would require a separate video. So to keep it simple, I'm just going to address one aspect of the covered call strategy because it's one of the biggest problems with QYLD. I gave you this brief explanation of the BXNT index, and QYLD's strategy is identical to that index. And the biggest issue I have with that strategy, which applies to QYLD and the index that it's chasing, is the phrase at the money. And at the money means selling options on the NASDAQ 100 index based on a price that's equal to the current price, which allows no room for appreciation. For the sake of comparison, the JEPQ fund sells covered call options above the current price. This is known as out of the money, and it allows some room for the JEPQ fund to benefit from appreciation. Now, you can debate the optimal price for selling covered call options. If you set the price too high, you get less income but more room for appreciation, and if you set the price too low, you get more income today but there's less potential appreciation in the future. But QYLD sets the price so low that it gives up all of the potential appreciation. Now, if you find that confusing, I don't blame you. And you can skip all the mechanics of options and get this concept simply from the fund manager's website. The fund manager is Global X, and it's explained in one of their downloads about their option strategies. Page 3 of that download says percentage of portfolio covered 100% for QYLD, and page 2 says 100% covered portfolio maximizes the premium income but forfeits all upside potential. Yikes. If you want a copy of that download, a link in the description. I'll close out this second red flag by reminding you that this strategy applies to the entire QYLD portfolio. By contrast, JEPQ's covered call strategy, which uses a different methodology, only applies to a maximum of 20% of their portfolio. And the remaining 80% is free to appreciate, just like the NASDAQ 100. Now, you can debate the methodology, but you can't argue with the results. So let's take a look at the performance of QYLD since it began back in 2013. Yahoo Finance allows a custom date range for its price chart, so I entered QYLD's inception date of December 11, 2013 and ran it to today, recording this on Feb 3rd, 2023. The NASDAQ 100 in yellow clearly beats QYLD in blue, but all those distributions, those Ds on the bottom, make it difficult to see the blue line. Seeking Alpha has a much clearer option. If you go to the momentum section, I think this one's much better. And I added my own labels to make it a little bit clearer. QYLD looked like a flat line compared to QQQ, but that's necessary for them to fit onto the same chart. I'll remove QQQ so that we can zoom in on QYLD's price action. And now we can see in more detail what happened to QYLD over the 9 years. Notice how those highs keep going lower and those lows keep going, well, even lower. Now, I'm no technical analyst, but that looks to me like a trend. So the takeaway for me from this graph is that if you own QYLD over that 9-year period of the fund and you spent the dividends, then you lost a third of your capital. So what if you didn't spend your dividends? QYLD pays out huge dividends, and if you reinvest them, you could use that to boost your returns. So to be fair, we should run that scenario, also known as total returns. I can't find a total returns chart anywhere on Yahoo's website. For some reason, price charts are really easy to find on the internet and total return charts are not. So we can use Seeking Alpha, and my subscription gives me access to custom date ranges for any total return period. If we run QYLD versus NASDAQ 100 total returns, we can clearly see the difference: 297% return versus 76% return. The takeaway from this graph is that if you reinvested your dividends over the 9 years, you didn't lose money. But you didn't make much money either. 76% return for a fund with the word NASDAQ in it, not that impressive. For returns like that, you could have gone with something much more sedate. Even a boring utility fund like UTG, which is not as sexy as a NASDAQ fund, but it beat QYLD on total return. And the price chart for UTG didn't set the world on fire, but at least it went up in value over that period. The last comparison I want to look at is volatility, because part of the attraction of these covered call funds, and there are many of them, is that you're supposed to flatten out the volatility, meaning when the market crashes, your fund doesn't crash as much. So let's compare a spike and a drop from recent history. When the Fed dropped interest rates a few years ago as a result of the pandemic, the NASDAQ went on a tear. A 93% gain from March 2020 to December 2021, almost 2 years. But QYLD only captured 29.6% of that massive gain. Then on the flip side, when the Fed tightened in 2022, the NASDAQ fell 33% and QYLD captured 58.5% of the drop. And credit to the Macrotrading article on Seeking Alpha for that last comparison. I updated some of the numbers, but they came up with the concept when they posted their article in November. To prepare for this video, I read the 6 most recent articles on Seeking Alpha about QYLD, and their article was the one I found the most informative and useful. The sign-up promotions might change by the time you see this video, but generally there's some kind of discount on the first year of subscription. They have 2 levels of subscription, Premium and Pro. I've been using the cheaper of those 2, Premium, since 2017. I'll put a link in the description. As I mentioned earlier, QYLD's attracted over $6 billion assets under management, so somebody must be making money from it. Maybe there's some effective trading strategy, like something based on volatility or selling when it hits its 200-day moving average. I don't know, but as an income investor, it's not for me. Recently, QYLD has been compared to JEPQ, which uses a completely different methodology. I made a video about the pros and cons of that fund, JEPQ, and I'll put a link in the description. That wraps it up for QYLD. More armchair income coming soon.